Hello everyone, welcome to EPK Capital. We simplify wealth management and investments so you can build wealth for generations. As a bonus, I've created an in-depth guide to the 7 costly tax traps for high net worth NRIs. You can download it by clicking the link in the description. If you're an NRI, you almost certainly have an NRO account. It's where your rent goes, where your dividends land, and where money sits when you sell an apartment in Bangalore. You probably think of it as a savings account, but it's not. It's a parking spot, and in global finance, parking spots are incredibly expensive. Hi, I'm from EPK Capital. We help families build, protect, and transfer wealth across generations. Today, we're cracking the code on NRO Repatriation. We'll talk about how to move your money out of India, legally, efficiently, and without losing 2% of your hard-earned wealth to hidden bank fees. First, let's clear up the biggest myth. Can you take money out? Yes. The RBI allows you to repatriate up to $1 million per financial year from your NRO account. That's roughly 8.3 crore rupees. This limit covers property sales, inheritance, and fixed deposit maturities, everything. But here's the secret most people miss. Your current income, like rent, dividends, or pension, is freely repatriable over and above that 1 million limit. If you mix them up, you're wasting your limit. At EPK Capital, we structure your accounts to strictly segregate income from capital, maximizing your total liquidity. Now, we need to address the elephant in the room, the 2024 budget. You might have heard the news that the government brought back indexation benefits for property sales. Warning, if you are an NRI, that rollback likely does not apply to you. While residents can choose between old and new tax regimes, NRIs are mandated to pay a flat 12.5% tax rate without indexation. This changes the math entirely. If you've held a property for 20 years, the inflation benefit was huge. Losing it means your tax bill could actually be higher despite the lower rate. We run these simulations for our clients daily because knowing your real tax liability is the first step to protecting your capital. Don't let the paperwork scare you. It's a standardized 3-step dance. If you know the steps, you won't trip. Form 15CB. This is where it starts. Your chartered accountant certifies that you've paid the tax. Form 15CA. You take that certificate and declare the transfer online on the income tax portal. Form A2. You take both documents to your bank and declare the purpose code. The biggest mistake? Trying to do this after you've promised the money to someone abroad. This process takes time. Start early and get your documents in order. Here is where you lose money without even knowing it, the bank's card rate. If you just click transfer on your banking app for $1 million, you might be paying a spread of 50 to 100 pays. On $1 million, that's a $10,000 to $20,000 loss instantly. Always demand the interbank rate. Negotiate. If you're an EPK client, our treasury team handles this negotiation for you, ensuring that the spread stays in your pocket. Moving money isn't just about forms. It's about strategy. If you're in the US, are you walking into a PFIC tax trap? If you're in the UK, are you prepared for the end of the non-dom regime in 2025? At EPK Capital, we look at the whole board. Your India assets, your global goals, your legacy. We don't just move money. We help you steward it for the generations to come. If you want to navigate the sovereign gate with confidence, let's talk. Click the link below for our detailed repatriation checklist.